We are about to discuss exercise 17 27B involving a cash flow hedge. But before we do, let's go back and review what we talked about in class on derivatives classified for hedging purposes. As we mentioned in class, the accounting for derivatives depends upon whether the derivatives is used for speculation or hedging. Derivatives purchased for or entered into for speculation purposes are entered into in an effort to gain a trading profit, whereas those entered into for hedging purposes is intended to reduce risk. The accounting for all derivatives on the balance sheet is the same. They're reported at fair market value. The accounting for the gains and losses that arises as the derivative increases or decreases in value differs depending upon whether the derivative is classified as speculative or hedging. Derivatives classified as speculative derivatives, the gain or loss in the value of the derivative runs through net income. For derivatives used for hedging purposes, the accounting outcome depends upon whether the derivative is classified as a fair value hedge or cash flow hedge. A fair value hedge is intended to hedge against the change in value of an asset or liability that's reported on the company's balance sheet, whereas a cash flow hedge is intended to protect you against the change in price of an anticipated transaction, a transaction that hasn't yet occurred but will occur in the future. For derivatives classified as cash flow hedges, the change in the value of the derivative initially bypasses the income statement and is reported on the balance sheet as a part of accumulated other comprehensive income in the equity section of the balance sheet. But when the transaction takes place that you're intending to hedge against, that transaction takes place and impacts net income, then the unrealized gain or loss that has arisen from the change in the value of the derivative is transferred into net income. So with that as sort of background information, let's take a look now at exercise 17 27B. In this problem, again, a cash flow hedge, we've got Lockett Jewelry Company. They use gold in the production of their jewelry, and they anticipate needing to purchase 100 ounces of gold in November 2014 for jewelry that they're going to manufacture and ship prior to Valentine's Day. Now, the risk that the jewelry company faces is that if the price of gold, their raw material, gold, increases, it's going to increase the cost to them of producing the jewelry, which, assuming they can't pass along to the customer, will result in them sustaining lower profit margins on jewelry sales. So, to protect themselves against the risk that that the price of gold will increase, they enter into a gold futures contract on June 1, 2014, and they designate this future contract as a cash flow hedge of the anticipated gold purchase. Now, the implication of that, as we just mentioned a second ago, is that any gain or loss that arises from the change in the value of the futures contract is initially going to be deferred and will not be recognized as a component of income until, in this case, the jewelry that is being manufactured by the gold is actually sold. Okay, so the notional amount of the contract is 100 ounces. And the term of the contract, of this futures contract, gives Lockhart, the jewelry company, the option to purchase the gold at a price of $700 per ounce. And the contract's going to be, this option, this opportunity to purchase gold, will be open until November 30th, 2014. In other words, the futures contract expires on November 30th, 2014. So here we're given some information about the spot price of gold. That's the price you'd have to pay if you went out into the open market and tried to buy gold on each of these dates. So on June 1st, which is the day we enter into the futures contract there, June 1st, the spot price of gold is $700 an ounce, and the futures contract here gives us the right to purchase gold at $700 an ounce. So obviously there's no intrinsic value associated with the futures contract on the day we enter into it. On June 30th, 2014, the spot price of gold has risen to $750 an ounce. Now our future contract gives us the right to buy gold at $700 an ounce. So this futures contract for us has a value of $50 per ounce. $750 minus the option price of $700. On September 30th, 2014, the spot price of gold has gone up to $825. Now the value of this option, of this futures contract rather, has a value to us of $825 minus $700, or $125 per ounce. So those are the basic facts. So what we're asked to do here is to prepare journal entries at June 1st, June 30th, September 30th, and then we're told that on November 1st, 2014, that we actually go out, buy our gold, and settle the futures contract. And from November 1st through December 15th, we manufacture the jewelry and we actually sell the jewelry on December 15th, 2014. So those are all the basic facts. So let's sort of start working our way through solving the problem. Okay, so on June 1st, 2014, there was no premium paid at the time we entered into the futures contract. There was no intrinsic value associated with the futures contract, because the exercise price of $700, or the purchase price of $700, is the same as the prevailing market price on that date. Presumably there's not any time value here, so the value of the derivative was 0 on that date, and so we've entered into a contract, but no cash changed hands. On June 30th, 2014, the price of gold has risen from $700 an ounce to $750 an ounce. So the value of our derivative on that date is equal to the excess of the market price over the price that the futures contract says that we can buy gold times the number of ounces included in the notional contract. Or we've got $5,000 is the value of the investment. So we're going to establish a balance in the investment in the futures account, which currently has a 0 balance. Establish a balance of $5,000 in that account by this debit, and we're going to have an offsetting credit of $5,000 that's going to go to the unrealized holding gain or loss dash equity account. So we're going to drop that balance in here. And the reason why that unrealized holding gain or loss is going to the unrealized holding gain or loss dash equity account rather than the dash income account is because this is classified as a cash flow hedge, and those gains that arise from the change in value of the derivative or losses are accumulated in this account until the transaction that we're hedging against closes out and hits net income. Okay, time marches on. Here we are at 9:30. On 9:30, the value of gold is risen up to $825 per ounce. So the value of the derivative on that date is calculated as $825 minus the $700 price that the futures contract allows us to buy the gold for, times 100 notional ounces. So the value is now what? 125 times 100, 12,500. 12,500 is the desired balance in the investment and security in futures contract account. Right now the account has a balance of $5,000. So to get that account balance from its current balance of $5,000 to its desired balance of $12,500, obviously is going to take a debit of $7,500 to the investment in futures account and an offsetting $7,500 credit to the unrealized holding gain or loss dash equity account. So we're going to debit the investment account $7,500, and we're going to credit the unrealized holding gain or loss account here for $7,500. Okay, so right now if we were to prepare the balance in the T account for the investment account, we'd have a balance of $12,500, and for the unrealized gain or loss we'd have a balance of $12,500. Okay, so now we're rolling forward to November 1st, 2014. What happens on that date is we go out into the marketplace and purchase 100 ounces of gold at the then prevailing market rate of $825 per ounce, and at the same time we settle the futures contract. So we're going to prepare two different adjusting journal entries, or two different journal entries, to reflect these two aspects of the events that take place on November 1st, 2014. The first, the acquisition of the gold. Well, gold is selling at $825 an ounce, and we want to buy 100 ounces, so we're going to pay $82,500 to buy the gold. So the entry is going to be debit inventory of raw materials dash gold, $82,500. After all, the gold is part of our raw material as a jeweler, and credit cash for $82,500 because we're going to, cut a check to the person from whom we bought the gold. Okay, the second part of the transaction is we're going to close out our futures account, or our futures contract. And the futures contract settlement is going to be calculated as follows. The futures contract gave us the right to buy gold at $700. The prevailing market rate of gold on that day was $825. So the difference between what we had to pay for the gold on that day versus what the futures contract allowed us to buy the gold at on that date was $125 an ounce. We bought 100 ounces. I forgot to make that a non-calculable cell. So we're going to receive a check when we settle the contract for $12,500. So we settle the contract, we get a check for $12,500, and that closes out the securities, the futures contract. So now we're going to update our futures contract T account to reflect the $12,500 closing out of the contract. And so the balance now in that investment in futures account is 0. Okay, sometime between the date that we bought the gold on November 1st, 2014, and December 15th, 24, we consumed all of that gold in the manufacturing of our jewelry. And so the entry that we would make, of course, over time as we consume that gold in the manufacturing of our jewelry is debit the inventory of finished goods for $82,500 and credit inventory of raw materials dash gold as we consumed those raw materials in the manufacture of gold, produced the gold and produced the jewelry and transferred the jewelry into our finished goods. In addition, of course, if you draw back on your managerial accounting, you're going to capitalize in the inventory of finished goods. You're going to capitalize the direct labor costs. You're going to capitalize, this was direct material costs. You're going to capitalize maybe other material costs, and you're going to capitalize some overhead. So the total balance in the inventory of finished goods account is going to, on the day that we sell the goods, is going to be higher than this $82,500 because it's going to include other components of cost beyond simply the gold cost. Okay, so what takes place on December 15, 2014 is that we sell our jewelry containing the gold that we purchased back here on November 1st. We're told here that we sold that gold for $710,000, and the cost of the finished goods, the cost of the jewelry that we sold, was $318,000. So we're going to book the sale here. So the agreed upon sales price for the jewelry was $710,000. Credit sales revenue by that amount. Let's just assume that we got paid cash rather than selling on account, so the offsetting debit goes to cash. And then we're going to transfer from the inventory of finished goods account to cost of goods sold the cost of the jewelry that we sold. And according to the facts of the problem, again, the cost of that jewelry was $318,000. So debit cost of goods sold $318,000, credit inventory of finished goods $318,000. Now, remember I said on a cash flow hedge that the gain or loss arising from the change in the derivative contract is initially recorded in the unrealized holding gain or loss equity account until the transaction that we're hedging against occurs and works its way through to the income statement. Now, the transaction that we were hedging against was a change in the cost of gold. The acquisition of the gold occurred on November 1st, 2014, but the transaction didn't work its way to the income statement until December 15th, 2014, when we actually sold the finished goods, actually sold the jewelry for which we bought the gold to begin with. So it is only when that transaction works its way and hits the income statement via this journal entry here that we're going to go ahead and recognize this unrealized holding gain or loss. Right now, this unrealized holding gain or loss dash equity account has a balance in it of $12,500. So we're going to zero out that account by debiting that account and credit cost of goods sold $12,500. So the balance in the unrealized holding gain or loss account, zero balance following this journal entry. So in terms of the impact on our income statement here, when you look at the income statement for the quarter ended December 31st, 2014, we're going to have sales revenue from this journal entry of $710,000. And we're going to have cost of goods sold. Okay, our cost of goods sold now is going to consist of two components here. It's going to consist of the debit to cost of goods sold here, $318,000, and it's going to consist of the credit to cost of goods sold here of $12,500. So bottom line, cost of goods sold $318,000 minus $12,500, $305,500. So gross profit. Another way of thinking of it is if we had not entered into the into this hedging transaction in order to protect ourselves against an increase in the price of gold, our cost of goods sold would have been $318,000. But because we entered into this hedging contract to protect ourselves against the increase in the price of gold, our cost of goods sold net of our hedging gain was $305,500. In other words, the hedging gain that we sustained of $12,500 offset the economic loss that we sustained because the market value of gold went up from $700 an ounce to $825 an ounce. So the big picture takeaway here is that we've got a cash flow hedge. A cash flow hedge hedges us against economic loss that we will sustain because of prices associated with an anticipated acquisition or an anticipated transaction. Prices may change before we're actually able to execute that transaction. So the accounting for that calls for us to report the derivative on the balance sheet at fair market value, defer recognition of the unrealized holding gains and losses associated with change in value of that derivative, and only recognize those unrealized holding gains and losses at such time as the transaction that we're hedging against works its way through to the income statement.